Welcome everybody to this episode of Covering DeFi. Covering DeFi is an interview series where we talk with builders and risk experts across DeFi. Today I'm joined by Ryan of Wallfacer Labs. If you're not familiar with Wallfacer Labs, they are a product studio that builds and contributes to products to move crypto forward. Wallfacer Labs is the team behind Vaults FYI and DAO deals, among other products. And I'm happy to be joined by Ryan today. We're going to talk through some of these products, talk about what Wallfacer is building. So welcome, Ryan.
Hey guys, thank you very much for having me here.
Ryan, do you want to give a little intro for yourself and for Wallfacer before we jump into things?
Yeah, sure. So my name is Ryan. I'm one of the co-founders of Wallfacer Labs. I guess this is year 6 professionally in crypto for me. Started my career back at Trust Token in 2018, working on stablecoins and then eventually TrueFi and real-world assets more broadly. And then we started Wallfacer Labs back in April of last year. So we just celebrated our 1-year anniversary. And when we started, we kind of started with a thesis around contributing to different DeFi protocols, whether that was on the technical side. Most of our team is composed of engineering and product talent today, and then also around getting involved in the governance of different protocols. And over time, we've evolved a bit, I guess you could say, to start building and developing more products of our own. The first of those is vaults.fyi, which is one of the reasons why we're here today, and one of the reasons we've gotten to know, or one of the ways we've gotten to know the Nexus team so well. But Vaults is, I would say today, probably the easiest way to find on-chain yields across Ethereum and a number of L2s. I think we have something like 150 different yield opportunities across 20 or 30 protocols, across 7 different networks, and continuously building that product out.
Yeah, I think Ryan, that I'm a big fan of Vaults FYI. I've been using it in the reports I put out on a weekly basis where I cover the state of DeFi yields. It's a really nice interface. It's a very easy way for me to figure out what the base rate in DeFi is. And, since I've started using it, you guys have made a lot of improvements. You've added more protocols. You've created different categories so I can sort by lending, sort by tokens. I mean, there's quite a lot that you can do with it. So I think it's a really neat tool and really beneficial. So I think let's start and talk about Vaults FYI. I'm gonna just drop the link to Vaults in the thread below this here. Just 1 second. All right, so you can find the Vaults FYI site just underneath in the comments for the space today. But I wanted to talk a bit about Vaults FYI. One, I wanted to start with what motivated you to build Vaults, and where do you see Vaults going, in the next couple quarters in 2024?
Yeah, so the second question, I actually would love to, maybe even brainstorm with you a bit about what you'd like to see from the product. But I think the brief history of it goes back to maybe May or June of last year, so right after we had started Wallfacer. And our team was exploring a couple different things. One of them was just around like a simple kind of rebalancing tool between the best, USDC yields on Compound and Aave. And additionally, our team had also always been a fan of the ERC 4626 token standard for different yield vaults. And you kind of put these two things together, and there is actually, I would say, a real difficulty in finding reliable historical yield data on-chain today. That comes from a few different places. One thing you see is that a lot of places that show you yields today use third-party data, like different kind of APIs, rather than actually sourcing the data directly from on-chain. In our case, we take the share price of different vaults to actually give what we think is the most objective historical yields, and then allow users to be able to make smarter decisions based off of that. One of the other challenges today is that, and honestly, this is something I didn't realize until we started working more on vaults, but different protocols basically calculate yield in different ways. So what do I mean by that? There are protocols like Aave and Compound that, if you go to Vault actually today, let's just, I'll pull up two quick examples. Or I can point you guys to two quick examples. You can pull up any Compound or Aave vault essentially. And if you click on one of the vaults on our page and you scroll down to the APY history, you can see that these operate more or less as a straight line. Like there are these linear calculations for yield where, every block you're getting something. At the same time, you can look at other, big kind of stalwarts of the DeFi space, even like a Lido or a Yearn. And in many cases, the yield in these protocols is actually kind of like pushed, I call it, to the holders, where it's not this simple linear calculation. And if you were, for example, to come in between the two of these different pushes, you would actually get a much different yield than if you were to kind of time that before and after some of these. So one of the things we do on Vault is just kind of standardize this into a way that makes it easier for all users to understand. For any technically inclined listeners that want to dig in, we have a great page in our docs on the methodology that I'm really proud of that I think just explains this in a very simple kind of way. And then, of course, there are real-world assets, which today are gaining in prominence and popularity. And those calculate yield in a completely different way, where we have to take in these off-chain oracles and stablecoin prices. And, it winds up just being this much more difficult calculation. But in a lot of ways, Vault, at least our homepage, is a way for a user who wants to compare kind of like for like to be able to do that across all these different opportunities and formulas for calculating yield.
Yes, I think that's one of the very beneficial things about vaults is, on Aave you can look and kind of see like what the historic yield is for the past month, but maybe not as granular as what has been for the last 7 days. But also broadly across different DeFi protocols, when you're looking at yield, there's two core things. One of them is, can you see what the historic yield is, or do you just see what the yield is at the moment? One of the things I come across when I talk to people about yield is I'll see something on Farcast or something on Twitter where somebody goes, "Oh, on Aave you can earn 55% on LUSD on Aave," and I'm like, "Yeah, but what is it over time?" Because that's kind of how Aave controls supply and demand, right? They offer
Exactly.
a really high APY, and then capital flows in, and so what is it actually over 7 days? Because if I'm trying to figure out where can I get the best yield somewhere for my risk profile, and I see it's 55% here and it's 20% there, I put it in, but the actual 7-day or 30-day average is actually like 12%, and the other one is stable around 20, then I haven't made the best decision for myself. So I think having that information is very valuable. The other thing that is really important that a lot of people don't take into consideration is what is the yield? Like, what is it comprised of? And so if I look at something like Seamless, for example, because you've listed Seamless here in the last couple of weeks, I can see what the base yield is for USDC or USDBC, and it's 5.47%, and the rewards that I'm getting in Seam are about 45%. So noting the difference between the base actual organic interest that you're earning in a lending market versus what the token incentives are really important for a lot of people, especially if you have to harvest that. Otherwise, you're taking on that market risk.
Exactly.
So these are really important things.
Exactly. And that's one of the toggles that we have today. If you go to the homepage, if you are someone that actually just wants dollar or ETH denominated yield and you're not interested in token incentives, you can just toggle that off. And so today, if you were to toggle that off, the highest 7-day APYs that we show are Morpho's RE7 vault, Spark's DAI vault on Morpho, some hop opportunities, but again on a smaller base. So that's been a very useful feature. The other thing that actually was initially our homepage, and I think we've edited a bit just based on what users like, but we have this optimizer tab as well. So vaults.fyi /optimizer. And there you can actually type in your preferences. So you can say you would like to earn on 10,000, let's say you're insensitive to any USDC coins and you plan to lock it up for 90 days. We'll tell you what the best opportunity is based on all of those factors. And this goes back to the point that you highlighted with some of these crazy temporary Aave yields, which is the way these things work is that if a borrower on Aave were to repay, I don't know, half of the vault or something, then there would be, a big underutilization, so the yield would drop, and vice versa. If someone were to draw down all of the available supply, the yield would spike. And that's just kind of a natural market mechanism to try and draw in more capital or convince capital to withdraw or rebalance themselves. So that's where things like the 7-day and the 30-day come in handy. I actually have a friend right now who is trying to get into crypto kind of for the first time and was looking at some of the vaults that we have on Vault. And I was just talking him through like, yes, this one is 55% today, but you're going to wind up with a bunch of this token that you've never heard of. Or yes, this one is, 90% today, but yes, for the past 7 days, it was 15%. So I think just being able to make more informed decisions is one of the things that Vault gives people today. And, your excellent newsletter is a great highlight of how people can take advantage of that data.
Yeah, and I could talk a bit about that too. The optimizer feature is really cool. I wasn't aware of that, so I also posted that down in the thread for the call today as well. But yeah, I think there's a lot of stuff. It's really intimidating when you're first getting into DeFi, especially when you're talking to somebody that's newer about where yield comes from, what you're getting paid in, what the factors are for things. I have to talk to people about risk, but just even understanding like where things come from. I've been to conferences before and talked to financial advisors about things, and they've asked a lot about yields, and I'm like, yeah, but what does it come in? Is it just interest, or what is the yield made up of? Is it actually token incentives, or how much of it is this and how much of it is that? And I remember being in a room full of like just traditional financial advisors being like, what? Tokens? And I was like, yeah, it's all tokens, but like what are token incentives and what are natural like interest you're earning on the tokens that you're putting in? And they were just kind of like very confused by this notion. So having that information is really nice, especially for people getting started. But yeah, you guys know that I've been putting out this State of DeFi Yields report for a little over a month now, and I use the vaults just to establish like what is the base rate. So looking at the highest yield opportunities to kind of get a sense of like where are things at. So I usually pick like the top like 10 or 15 and use that as like the range of what the opportunities are. If there's anything that's an outlier, I kind of note that as well. But it's really useful because one of the core building blocks for yield in DeFi always comes back to lending markets. Lending markets are major drivers for yield, and so being able to filter on vaults and look at the different lending markets and then, just kind of segment things out by either stable coins or ETH is incredibly valuable for me. So it's been a big help when I've been writing this. And also a lot of this fits in with a lot of the conversations that people have had here in the last, I would say month, but definitely the last week about like Maker and Morpho and Athena and Aave and kind of everything tied up in there, with concerns about risk. But when you're looking at some of these yield strategies that people are using in DeFi, and then you look at yields on vaults across lending markets, you can kind of see, some correlation. So if I'm looking at the RE7 USDT vault, why is the yield so high, right? Why is this higher than other lending markets? And if you actually go in and look at it by clicking through on vaults to the actual market on Morpho Blue, you can see what the main things in the market are. And the main things that people are borrowing USDT for is to farm either SUSD yields or USDE yields. So again, it's that that appetite that people have to either earn that leveraged yield on the staked USDE token, where that's earning yield from the delta neutral strategy that Athena is running on centralized exchanges, or the people that are just leveraging long on USDE to farm the shards that will be available for, that'll be converted to ENA at the end of their season 2 that they're running. So, I mean, Athena has been a big driver of yield, but if you're looking at those things, you can actually click through in those markets and kind of see, oh, this is why it's so high. So I think that's really interesting too, is that I can usually track based on the yield I'm looking at to some of the narratives that I can see on crypto Twitter and some of the things that I can read on different governance forums, whether it's Makers or Aave's. So it's been really helpful, and I kind of cover that in this week's issue as well. So yeah, really great.
Yeah, and obviously that's one of the things that, or I should say not obviously, but one of the things that I've certainly picked up from just looking at vaults daily now is how really it feels like the first time in lending markets in crypto in a while that we're seeing new entrants really make a splash. If you were to turn off the rewards filter on vaults today and look at the top yields, it's, in the top 10, you've got Morpho, Athena, you've got X Savings Die, Ajna. A lot of these are fairly new. And you don't see the more established names like Aave and Compound near the top as often anymore. Some of them do still have pretty high yielding vaults, but just at a quick scroll here, let's see. So on the 7-day APY, the first high yielding vault we see from Compound and Aave are Compound's USDP vault, which is very small. I wouldn't even count that. Aave's V2 LUSD, which also is very small. And probably the first notable one here is Aave V3 USDC on Polygon, which is 15%. And that's, a third, less than a third of some of these top Morpho vaults today. So I also kind of feel like we're seeing a slow changing of the guard. Now, granted, in this Morpho one, like you highlighted, it's mostly just Athena, but still.
Yeah, it is interesting. I mean, I think one thing that I've definitely noticed is you've got Compound and Aave, which have very different risk frameworks and how they manage risk, right? So Compound collateral that goes in does not earn interest. You can only earn interest on either WETH or USDC. That's the model they've chosen. Aave is the peer-to-pool, where risk management is basically handled by the risk providers that are active service providers within the Aave DAO, and they're managing things across multiple markets. They're handling onboarding for listings with other service providers like AaveChan. So there's a lot going on there. And the whole idea behind some of these other markets like Ajna, Silo, Morpho Blue now, these are all permissionless lending markets. Some of them use oracles and some of them don't. So Ajna does not use oracles. It's more of like a limit order basis for lending where you put in the rates at which you would like to lend. They have a very interesting design on how they operate without oracles. Basically, you can add anything in there, and there's no one managing things. Somebody can set up a market, and somebody can start using it. Whereas Morpho Blue is permissionless, but still they have this layer that's built on top called Metamorpho, where you can have risk managers come in, create vaults, and make it easy for people to deposit into those vaults, and then they kind of allocate those capital within the vaults to the markets that they make on Morpho Blue, since it's not as easy to interact directly with permissionless lending markets. So you can definitely see a change of the guard happening, but a lot of these permissionless lending protocols are on the newer side. So it's interesting to see them taking off. One thing I wanted to ask about is how do you decide what to add into the vaults interface? I know you talked about having it be a friendly place to look for yield, but what are some of the things you're looking for when you're adding new protocols within vaults?
Yeah, happy to take that. I also just want to bookmark one of the things you said about Compound and Aave kind of being driven by these risk managers and how places like Morpho have transformed that. And maybe we can come back to that. In terms of what we add to vaults, we have kind of some hard criteria and then kind of some softer criteria too. So historically, we've looked for vaults that are at least about $1 million in TVL. We make some exceptions for that for more established protocols. Like you'll see a bunch of smaller Aave and Compound vaults on there. We kind of use TVL as almost like a proxy for excuse me, kind of like security and the lindiness, you could say, of some of these things, how long they've been around. What we don't want to do is show opportunities that are kind of too early, where we still think there's a ton of risk of the protocol actually being proven out from a security and safety perspective. At the same time that we try to find a balance with that, like with some of these newer Ajna vaults that, we think that just kind of given the caliber of the team that those are safe vaults to show, even though they are relatively younger, just as a protocol. And then outside from there, we get a lot of requests from people. And so sometimes we'll prioritize if, people kind of, show us something that maybe has been around and we haven't seen. There's been a bunch of cases of that where we've added things recently. But yeah, just trying to show a good kind of risk-adjusted return for different people that are coming to the site. I guess the only other hard criteria worth mentioning is that all of the things we showed today are single asset yield opportunities. So it's deposit one token, get a yield. We don't have like Uniswap LP tokens or more complex positions like that. Part of that is just the desire to keep the product kind of straightforward for users and make these actually easier opportunities to deposit into. And at least from a market perspective as well, the majority of the market is majority of the yield market are these single asset yield earning opportunities.
Yeah, I would agree there. I would say having a site where you can look at different yields for like Uniswap LPs and everything would be interesting. But for most people that are already doing that, they kind of already have their strategy on how to calculate that out. And it's, I would say for the average user, cumbersome to provide liquidity on Uniswap B3 directly, which is why most people are going through some of these liquidity management protocols as well. So I definitely agree with that approach. Simple enough to look at the yields, simple enough to find the opportunities, and then it's just going to the site, looking at it yourself, and then depositing a single token. I think that's a pretty good place to start. You could always make out like an advanced version of it, but there's plenty of single asset yield opportunities out there to highlight.
Yeah.
But yeah, happy to go back to the point that you had bookmarked there on risk management across lending markets.
Yeah, so we put out this Wallfacer Weekly every week now, and one of the themes we've covered is sort of this like shifting of alliances, maybe within crypto, I guess you could say, where Gauntlet, for example, who historically was a very large service provider to Aave, recently kind of publicly left the Aave DAO to become a vault curator at Morpho or vault creator. And one of the shifts that I think that I've seen here is you're right that these risk providers are, one, very expensive, and two, very critical to these DAOs. I think right now Aave has 2 or 3 risk providers. They have another one that just proposed yesterday to sort of join them as a risk provider, and they spend, I think, upwards of $3 or $4 million a year on these service providers. With Compound today, I mean, just kind of going through their governance forums, it seems like the day-to-day of the protocol is kind of basically run by Gauntlet, just updating parameters all the time. And those are just a cost to these protocols today. I think the way that these protocols can now interact with a place like Morpho is that they're more of a partner. And someone like a Gauntlet or a Chaos or whoever can actually think about building a business for themselves that has more of this uncapped upside on a place like Morpho than they could at a place like Aave or Compound, where they're just getting an annual service fee. And historically, they have tried to work some of these more incentive-based mechanisms into their contracts with the stalwarts like Aave and Compound, but they just kind of haven't paid out. But now with a place like Morpho, they can create these vaults, they can earn a service fee, and if the vault grows to be $1 billion or $10 billion, they're earning a basis points fee on that AUM now. So I actually think it's very transformative in the relationship of how risk managers can think about monetizing their expertise in these fields, which I think is one of the things most exciting to me about watching this changing of the guard, essentially.
Yeah, I think it depends. It depends on the model. So I think there's benefits and trade-offs on both sides. I think that having a service provider running their own markets on Morpho Blue, for example, they can make money, and basically their success is based on their drive to market this thing, to get it off the ground, and to build up AUM over time and earn fees off of it. Is it as lucrative as, say, being a service provider within Aave or some of these other places? I'm not sure. I guess it really depends on how big they get and how big they grow. But I know Gauntlet for quite some time was being paid about $2 million a year within Aave. I think it was probably somewhere around the same for Compound. And they also, I know Gauntlet works with other protocols as well.
Mm-hmm.
I think the thing with Aave that was kind of contentious is that Gauntlet was working with people that Aave considered competitors or
Right.
other Aave forks and everything. And Gauntlet has made mistakes in the past, but I think every service provider is prone to do that at some point. One notable thing I had covered in issue 4 of my newsletter was that there was a mistake on the Compound Arbitrum native USDC market that resulted in the borrow interest rate being very, very high when utilization was not. And so that had to go through governance, through the 7-day time lock and everything to get fixed. So, some of these things can still end up, but I would say if you have someone like Gauntlet running their own market, if that impacts the trustworthiness of them as a risk manager, then people will allocate elsewhere, right? So you have different options within the same protocol so that maybe you're not losing TVL, but it's just shifting over into other markets. So I do think it's interesting. I think it's interesting separating out the risk players. I think both over time, both of them will still continue to grow. But one of the benefits of something like Morpho or Ajna is that these lending markets are isolated. It's not peer to pool, right? So you're not being exposed to the risks in other markets based on the market that you're in, like you are with some of the protocol designs like Aave. But the benefit with Aave is that they're more capital efficient. So that is one of the trade-offs. But at the same time, if you're trying to limit risk, you can put your funds in one market, you can lever up, you can kind of play across the different markets. There's a lot of benefit to that as well from a risk perspective. So it will be interesting to see how this stuff scales over time, but we're seeing more of these permissionless lending markets come around. And thankfully, they're not a bunch of Compound V2 forks anymore. So that's a major plus.
Right. Yeah, one of the things we've talked about a bunch is just, looking at Gauntlet's work, just as an example. This applies to many service providers, I think. Gauntlet is probably one of the foremost experts in the space in terms of optimizing lending markets. They worked for Compound, Aave, like you said, all of these V3 forks, Pancakes, Blend, or whatever. They work for all these different things, and you could make an argument that they are probably one of the players in the space who, in theory, would be most primed to launch a lending protocol of their own that could do well. And I think Morpho is kind of a way to test that thesis, and I think it's really cool. Also, RE7, I mean, their vol, I think, is one of the highest yielding ones on Morpho today. Historically, I know them as one of the smartest funds in the space for managing their own book and optimizing yields. So it's really cool, actually. I'm excited by Morpho, especially, but Ajna, I'm not as much of a kind of deep expert on that, but obviously they're doing a lot of interesting stuff too.
Yeah, I think each one has a different approach, but I do agree. I think Morpho Blue and Metamorpho are going to be really interesting. If you're a fund that's already managing things, you can route your own deal flow through your markets, right? So I mean, there's a lot of benefit there and a lot of optionality. I think for a lot of these people, so Gauntlet has been around forever, right? Like everybody acknowledges them as a really great risk expert and a great provider in the space. Chaos Labs is a bit younger, but they also have a very good reputation.
Absolutely.
But I think some of the ones that people often forget about or maybe aren't as aware of because they've been working with Maker, and Maker has been around for, at least in DeFi, for forever, right? So like what, 3 to 5 years? But
yeah, can't get much earlier than Maker.
Yeah, so Block Analytica has a market, and they're working with B Protocol, and they've been around for quite some time as well. And they're also working with Maker. They've done the due diligence on Athena for the allocation into the Spark DAI Vault. There's a lot of these different risk players that have been working with these protocols, and so the ability to make their own markets and scale these up, very much agree that it's exciting to see. And unlike a lot of other permissionless lending markets we've seen before, it's not like, create your own market from scratch, choose whatever oracle you want. There's some guardrails there as well. So as far as I'm aware, all of the oracles used within Morpho Blue have been Chainlink oracles so far. Maybe some Redstone, but I haven't dug too deep into that.
Yeah, I mean, it's a little bit of a Web 2ism, but you look at some of these giant businesses like a Spotify or something, or sorry, Shopify, businesses that kind of allow other people to create businesses with all of this infrastructure. In some way you could think about Morpho that way, Morpho Blue, I guess. So Yeah, we'll see. Obviously, they're off to a great start.
Yeah, I definitely agree. Having the thin protocol approach where you allow people to build on top, and I think this was one thing that Paul from Morpho had a long discussion about on Twitter um, with the founder from Euler, was about what is the product, what's the protocol, and what's the product. But the thin protocol approach is essentially what we're doing at Nexus, right? You have this risk management infrastructure. You can build businesses on top of it. You can develop new products. You can do these things. So the ability for people to come in and build their own businesses on top of a protocol and essentially do whatever they want within reason is just, I think, kind of what we set out to do in DeFi and what we set out to do in on-chain markets to begin with. So it is neat to see a lot of those developments coming through.
Absolutely.
But I think getting back to talking about what Wallfacer Labs is building, is there anything before I go back to Vaults FYI? Is there anything else that you guys are working on that you wanted to talk about?
Yeah, so there's two other things we're working on and active with today. I guess just about 2 or 3 months ago, we got a grant from the WorldCoin Foundation, and we're building out some grants distribution and kind of governance tooling for them that we're very excited about. The app will be, I don't know what the right word here would be, but kind of WorldCoin native in that it accepts the WorldCoin ID and is sort of built around that primitive, which we're very excited about. And we hope we get to put it to use in their next, or maybe 2 from now, round of grants. We'll probably have some more out about that within this month. And then where we have worked since we've gotten the company off the ground is with TrueFi. TrueFi is I think many people know TrueFi as a crypto native lending protocol, historically for lending to market makers. TrueFi has done about $1.8 billion in loan originations. And recently we've just had 2 big announcements out of TrueFi as well. Cicada Partners, which historically was one of the largest originators of loans on Maple, is moving off of them and coming over to TrueFi's tech stack to start originating loans to market makers and trading firms again. We believe it's a good time for that market, as there is a lot of demand and there's not really anyone to fill that today. As a part of that, we're looking to help expand TrueFi to different L2s as well. So we're looking at Base, a lot of things on the OP stack, some of the things within Arbitrum. And then secondarily there, we also recently proposed, kind of within the TrueFi ecosystem, launching a new protocol called Trinity, which takes advantage of a lot of the things that I think we've learned from both studying the RWA market and some of our work on vaults, just trying to give the DeFi native benefits to these different RWA assets around composability, transferability, and many of those different principles. If anyone's listening is interested, you can go to forum.truefi.io and learn about both what we're doing with Cicada there and with Trinity as well.
Sounds like you guys are definitely busy.
We are. Yeah, this past week has been a long one.
But yeah, that's all very exciting. I'm looking forward to reading a little bit more about that. Do you have more other than what you have on the TrueFi forum? Do you have more about what you're working on with WorldCoin? Is there anywhere that I or anybody else can go and read about some of these developments?
With the WorldCoin, not so much. I think we had a tweet on the Wallfacer account just kind of detailing the spec of that. But I'm hoping within this month we'll probably have a demo or some kind of live product out there. On the TrueFi side, actually one of the places I'll just kind of plug some of the content we've been doing. If you go to the Wallfacer Labs Twitter, we just put out our quarterly State of the RWA market recap, and we have a few slides on there towards the end of what we're doing with TrueFi.
All right, great. I will definitely check that out after this call.
Awesome.
Yeah, so I wanted to go back and talk a bit about vaults. Specifically, I know I can put in basically in the URL like base.vaults.fyi, and I can look at yield opportunities within a given market. I know I can filter that out within the main Vaults FYI app, but am I right in saying that? Is that available for most of the big networks like Base and Optimism?
Yes, that is. And then we also have, if you go to yearn.vaults.fyi, a custom subpage that we built with them to be able to capture some of the nuance around Yearn v3 vaults. So Yearn v3 has this ability for the community to be able to create vaults essentially in a semi-permissionless way. And so if you go to yearn.vaults.fyi, you can see that we have some additional just kind of data around that. So whether it's a curated vault by Yearn or a community strategy. And we also want to try to expand this for some different protocols as well. So you can see here at the top, we have this TVL across all of Yearn v3. We have the search and optimizer specified just for Yearn vaults. So if the Yearn team wants to make it easier for their users to search, they can point them here. And really any protocol that has a lot of nuance that would be tough for us to capture on the main page, we are open to doing these custom subvaults to try and capture some of that.
It's really interesting. Yeah, and I can see here you've got the tags for Yearn created vaults or community strategy, which is really nice to see as you're looking through. One thing I know we talked about how you calculate APYs earlier, but I wanted to go back real quick and ask for like the juiced vaults. So the Yearn Ajna vaults that you're calculating the yield for. So for the DAI vault, for example, you have the base rate and then the juiced rate if you choose the extra APR. And based on what I understand from their docs, that is generated on a weekly basis when they liquidate the Ajna tokens into extra yield. Is that right?
I believe that is correct. Actually, I see Tyler's on the call. I think Tyler, my colleague, would actually know that detail a bit better, but I believe that is the case. And I think actually the interesting thing here about these juiced vaults is that, if you kind of look at Ajna's approach to how they've gone to market, they've really partnered with a lot of people in trying to get themselves out there, and I think are doing a great job of positioning themselves as just this infrastructure kind of back end for yield without them feeling like they need to own the front end or kind of marketing of some of these experiences. So I think the work that they've done with Yearn kind of broadly here has been really smart and exciting in terms of the go-to-market.
Yeah, I agree. Absolutely. It's been really neat. I mean, you've had Yearn build on it and create the Juiced Vaults product. And then they've worked with Mom, which is I think it's within the Yearn ecosystem, but kind of their like front end design arm to make that juice.app page where it's all specific and you can actually see the different pools. So I haven't checked. I'm going to look on DeFi Llama right now just to see what Ajna's TVL looks like now. But I remember looking at Ajna because they've been around for, I don't know, at least a year, if not. They've been around for just about a year.
So they, if I remember correctly, they actually launched about a year ago, and then they had they called it something else, but basically a bug, and so they, I think, turned off deposits essentially for their vaults, and then they relaunched just back in January. And so if you look at the total TVL chart, that's where you see that kind of big lull in the middle, and then they started growing again back in January.
Yeah. They had like a disclosure, and they kind of went from their V1 to their V2. But,
exactly.
When I looked on them at the beginning of the year, they were around like, I think 11 million.
Mm-hmm.
But if you look at it, it's just like a straight line up, and they've been hovering right around, 20 to 30 mil ever since. So I think, the only thing has been kind of the market going back down. The TVL's gone down because there's a lot of ETH and things on Ajna, but now they're on base. They're doing quite a few things. So it's been really interesting. But again, going back to that composability, how important composability is in DeFi is that you have someone like Yearn that builds on top and uses that as a growth building block. And the juice vaults have been crazy. I mean, they're not as high as they were, let's say, a couple months ago, but consistently when I was looking on vaults, like week over week, they were one of the top performing, yield vaults out there. So that was really, really cool to see.
Yeah, one of the other things that on Ajna I find kind of interesting is that a little bit less on the yield side, more on the kind of token go-to-market side, is that their token has been live for a bit, but it's live at like, I don't know, maybe 1% or like some 0.5% of the total supply or something. And I think I've been meaning to actually kind of dig in a little bit more to this, but they have, I think, an interesting go-to-market as well and sort of rollout of their token that I think doesn't follow the traditional like investor 3-year, 4-year vesting type of schedule. And I think it's more they're going to kind of launch the token all at once at some point in the near future, which I also think is kind of novel. Like if you look back to, early Aave with like ETHLend and Lend, I guess was the token, more of the ICO type of approach for a token launch. I'm curious how that plays out in practice as well.
Yeah, I think if you want to go off on a tangent about token distribution,
Let's do it. Yeah.
For a hot sec, it's been really interesting to see because there's been a big shift, right? So DeFi summer came, Compound put out valueless governance tokens, used it for liquidity mining, and then everybody for about a year and a half did the same thing. Now we're in this cycle. Within the last year, people have figured out that giving people governance and giving people the ability to vote on changes to the protocol, while theoretically is a good idea, that direct democracy, just like it doesn't work in the real world, doesn't really work on chain either. So people have been trying to figure out how do we minimize governance because people tend not to participate in voting. Gas fees can be prohibitive. How do we add some token utility to this thing and remove governance? So for a lot of people that have had tokens out there, like the governance approach hasn't been a successful one. So there have been people that have kind of been experimenting with what's the more utility. Now for Ajna, I'm not extremely well versed in how they distribute their token, but from what I understand, they have their reserve that they get, which is just the net difference for people listening between the interest that's being paid by borrowers and the interest that's going to lenders. And that is basically auctioned off for people. So I believe you can basically sell Ajna tokens back to the protocol for the reserve fees, if I'm remembering this correctly, and then they burn the Ajna tokens. So it's supposed to be this like deflationary release over time. I think it's been a little bit since I've read about that, but just a different like utility for their token that makes sense for a lending market. But with things like the points craze, which I've written about a lot, it's been really interesting to see protocols take off, like Pendle and Gearbox. Everybody that's benefited from this points craze around liquid restaking tokens, or just around Athena with the tokenized basis trade. So with these things, people are distributing tokens in new ways where you have this essentially promise token, the points, which are some of them are Web3, but most of them aren't really on chain. They're just Web2 accounting. And instead of just saying, all right, now your points are convertible for the token and you can do it over this amount of time, it's okay, you've earned points for this season. Now you can redeem it for these tokens now, but we're going to be doing this 5% at a time per season so that you kind of continue that growth metric. As far as what these tokens will be used for, some of it will be governance. There's some different utility, but just a different distribution strategy, which I think we can see for all of these liquid restaking protocols has been very successful. Mind you, successful for protocols that don't actually have any real yield yet for the most part. You have the staking yield that underlies them, but for everything that's built on top of Eigenlayer has like, what, about $12 billion in TVL, and they're not actively validating, any different networks yet. So they're not live. There's no real yield. It's just speculation around these points. So it's been really fascinating to see that take off over time as well.
Yeah, definitely. I think that sort of more over time, sort of continuous distribution of points, whatever, kind of these seasons and stuff that people have been doing makes a lot more sense, I think. And I do think there's still a ton of white space within, overall token go-to-market, distribution, all that kind of good stuff. I'm surprised still that, that I know a few protocols that do it that are fairly large, but that more protocols don't even have like a small annual inflation just to, almost like upfront as a hedge, just to say, hey, we don't actually know in 4 or 5 years what the state of the market will be. Like maybe we still need this for some reason. But yeah, I think there's still a lot of white space there.
There are tokens that have, like, you can issue new tokens. They're like, is inflation built in the contract, but nobody ever wants to use it.
Yeah.
because everyone is fixated on, like, the Bitcoin example of there's no more than this, and in fact it's deflationary.
Of course.
But my personal opinion is that tokens are not like equities, and they behave differently, and that the buyback and burn method doesn't work as effectively as some people think it does on chain. But that's a whole other discussion.
Yes.
One thing that I think that personally for me that would be interesting is like maybe not on the traditional vaults page, but something that looks like a marketplace for like Pendle yields or things like that, like a vault for points, basically. The points marketplace, just because people are trading these things, like on.
That's good to know.
Yeah, like what is it, whale something?
Oh, sorry. Whales market, yes.
Yeah, so there are some markets for these things, and it is interesting to see people kind of speculate on this. And again, like Pendle has been, I think, the primary place where people are basically kind of dictating the current rate for some of these tokens. So yeah, it's been really, really interesting.
Yeah, I'd say just across the board, there's so much to keep up with across all of DeFi and yield right now, which is exciting, as it maybe didn't feel that way a year or so ago. So having all these new protocols come to market, these new distribution methods, these new ways to earn yield, to speculate, that's what makes crypto fun.
Yes, definitely. It's very interesting. I think, like I've said before on other formats, but the whole reason I started writing the State of DeFi Yields report is that I do this basically every week when I'm going through and doing risk assessments on different protocols, staying up on governance forums, and kind of summarizing these things. So I thought, why not put it into a newsletter for other folks? And then, of course, you guys came along and made my life a lot easier by putting together nice calculations for the average APY over a week. But there's a lot of new stuff coming around, and so it's interesting to see what people are building. It's also interesting to see the risk profile that people take on as, like, the market evolves throughout the bull market that we're currently in. So it's definitely interesting. I will say for people listening, there's definitely still risk out there. I think one of the benefits for Vaults FYI is you present a lot of more like risk adjusted strategies and simple strategies. So people can kind of click in and do their own research, but you break down a lot of the important factors right there on Vaults, which I greatly appreciate as well, especially when I'm trying to talk to somebody about something and I'm sending them over to Vaults.
Great, thank you for that. Yeah, so what's your day-to-day like on the Nexus side as well with some of this risk and, like, I guess from a practical perspective, are you using Vault at all on your day-to-day, or?
Yeah, I'm usually looking at vaults just to kind of gauge what interest rates are across lending markets. Lending markets usually act as a signal sometimes. So, for example, when everybody was talking about DAI with the allocation to Morpho, for the Athena markets, and everybody was kind of upset about how quickly that moved through and some of the due diligence and things, and I had summarized that in issue 5. But there you saw lending rates kind of spike for DAI in certain places because some people transferred their debt over to DAI because they thought, well, if it is risky and something does happen, then I'll just hold DAI as my debt, because if it depegs for some reason, then it'll be much cheaper to pay this thing back. So you can kind of see market rates react in a certain way. And usually if something's higher, I go and check it out and just make sure, what is this thing reacting to? I'm also looking through governance forums on a pretty regular basis. I always tell people it's great to read DeFi governance forums to your kids if you want them to go to bed. But sometimes when you're reading them, that'll keep you up awake at night. So, but that's kind of what things look like for me on the Nexus side. I do a lot of risk. I'm also looking for new protocols that we can list that people basically want to deploy funds into, but risk holds them back. So I try to keep my finger on the pulse for newer protocols coming across the way. I will say, like for Morpho Blue, the approach that we take at Nexus is we list individual markets as they come online, because things are permissionless. You almost want to review every market, look at the oracles they're using, and then list them that way instead of just saying, full force, anybody that creates a market here is covered. So I use it to look at some of the ones that are higher performing, some of the ones that have traction with a certain amount of TVL, it's very beneficial for that. But yeah, I will say that I use vaults every day in my day-to-day, looking at yields as a basis. Some of the more far-flung stuff isn't on vaults, but then again, that stuff isn't as easy to comprehend, and it's not for the average user. It's for some other power users. But a lot of my job is looking at risk, trying to find different narratives, keeping up on yield opportunities, and then taking things back on the product development side and seeing if there's something that's missing. If there's a need within the market that doesn't have a cover product for it, or if there's something that could be listed that people could benefit from, that's usually what I'm searching for on a day-to-day basis throughout the week.
Yeah, well, I'd love to, we're always open to feedback, and if there's anything we can do on the vault side to make your job easier and have that be a bigger part of your analysis, we'd love to see what we can do.
Yeah, like I've said before, adding the different categories like lending and stuff where I can kind of narrow things down and look at certain markets has been a really big help. And again, when I started writing this, I basically just used like maybe a couple screenshots from vaults in my early newsletters. But now I go through and I just kind of provide screenshots of each individual market as I filter through to give people some insight onto like what are the rates across different markets. So, the improvements that you've made since I started using vaults have been really helpful.
Good. Glad to hear that.
But I will give you more feedback as I come up with it, though. So, can look forward to that for sure.
Good.
But yeah, we are getting close to time and everything, so I can wrap things up. Is there anything before we head off for the day? Is there anything that you wanted to highlight or anything you wanted to note, Ryan?
Well, we've got a bunch of new things coming to vaults as well. So we're adding some additional features around charting to make it easier to compare historical yield between different vaults over time. And I would also say we haven't really announced it, but if you go to our homepage, you can see that we have kind of a V0 of our API out there. We're in the middle of making some fixes, and then we'll have a bigger announcement about that next week. But if people want to use that or have questions about that, please feel free to reach out. You can always reach out to me directly. My Telegram handle is just right in my Twitter bio, or you can DM the Vault account. I think the DMs are open there. We check those regularly and we get in touch with people.
That is awesome. Yeah, I'm definitely looking forward to the optimizers. I'm going to check that out more for sure. And then the Yearn page as well. I'll be looking at that more often, and I'll probably put that in the next report. So thank you for sharing that on this call.
Awesome. Well, thank you for your time, and thank you for being such a user and supporter of the product. We greatly appreciate it.
Yeah, absolutely. So for those listening, if you haven't checked it out yet, head to vaults.fyi. Lots of ways to check out yield opportunities, lots of ways to filter. You can look in the comments section of this call, and you can find some of the different things that we talked about on the call. Ryan, thank you very much on behalf of everybody on the call for sharing some of what you're working on from Wallfacer and Vaults FYI. We will announce the next installment of the Covering DeFi series in the near future. But thank you, everybody, for listening today. I hope everybody has a great day, and we will see you on the next call.
Thank you. Talk soon.
Bye, everybody.